Hi, my name is Brenton Harrison with Henderson Financial Group, and we're here to talk about a few ways you can rescue your loans if they've gone into default. Let's get started. The average student loan balance has skyrocketed over the years compared to what previous generations had to take out to borrow for school, and unfortunately that's put many people in situations where they feel or they can't afford the payments that their loan servicer has offered them, and instead of trying to find a way to negotiate that payment, they instead choose to ignore it, and unfortunately their loans go into default. Now, defaulting on a federal student loan is a very big deal. For one, it strips some of the benefits that you find with federal student loans compared to private loans, like the ability to apply for new student loans or the ability to put your loans into deferment or forbearance when you can't afford the payment, even your ability to pick any repayment plan that you choose, and even in some states it leads to your wages being garnished and a professional license being suspended. So if you're a teacher or a nurse and you require those professional licenses to do your job, you could even see a student loan default impact your ability to do the thing that you do on a daily basis to actually earn the income needed to pay back that loan, which seems counterintuitive, but that's the way it is. In addition to that, there's a very lasting impact on your credit score when it comes to a defaulted student loan that's listed on your credit report, and you want to make sure that if there's any way possible to get that off your report that you can do so. So we're here to offer you a few ways that you can do it, either in a way that allows you to at least get your federal student loan back in good standing, but also one way in particular that will allow you to get that default off of your student loan credit report, or your credit report, in entirety. So let's get started on some of those ways. The first way to rescue a federal student loan that's gone into default is to go through a process called loan rehabilitation. And to go through that process, we have to make sure we differentiate between when your loan is delinquent and when your loan is in default. When you have a federal student loan that you haven't paid for at least 90 days, your loan has become delinquent. And that's something that will show up on your report because of those late payments, but it won't necessarily list a default on your credit report. So after it's been 90 days, your loan is delinquent. Once you've had a late payment for more than 270 days, now your loan has gone into default. And in addition to those late payments, you will see a default that's listed on your credit report, which is something that if you don't do something about it, could stay on your report for at least 7 years. Now, we're going to talk about what's called loan rehabilitation, and that's the only option that we're going to cover today that actually takes a default off of your credit report. What loan rehabilitation is, it's a process that is a 10-month process, and it allows you to put your loans in a place where you're able to restore the privileges that are associated with federal student loans, like the deferment or the forbearance, or even eligibility for a new loan. What happens with loan rehabilitation is that you sign up for the process, and your loan servicer will give you an amount that you have to pay over a 10-month period. That's 15% of your discretionary income. And if you want a reminder for how that discretionary income is calculated by your servicers, I encourage you to go look back at some of our older videos about how to calculate a federal student loan payment program. But once they found 15% of your discretionary income, if you pay that amount for a certain period or a certain number of times over a 10-month period, you can have your loans what's called rehabilitated. And in addition to having your federal student loan rights restored, it takes the default off of your credit report. It won't take the late payments off of your report, but it does take the default off of your report, which again, if you didn't do, is something that would stay on that report for a minimum of 7 years. So that's a very, very big deal. Depending on how long your federal loans have been in default, you might be in a situation where you are already having your wages garnished as a result of those past due payments. Unfortunately, you can also find situations where if you were due for a federal tax refund, that the amount that you owed in defaulted payments could be used to offset that refund that you were due to get from the federal government. So again, it's a very big deal. Unfortunately, when you go through the loan rehabilitation process, you have to make those payments of 15% of your discretionary income, and they do not take into consideration the amount that's already being garnished from your check. So this is a downside to the loan rehabilitation process, in that you could be paying even more than that garnished wage to make sure you get back in good standing. But the benefit is that you get that default off of your score, which won't only just help you with your credit score, but will also help you if you're in a situation where you need financing for any of the other things in your life in the future, be it a business loan or a mortgage or any of the other reasons that you might need future lending. The next option when you have a federal student loan that's gone into default is you can consolidate the federal student loan. So if you're not familiar with the consolidation process, what happens is you take all of your loans, whether it be 3 or 4 or 5 loans that you've taken out over the course of your schooling, and you consolidate them into one new consolidation loan with the federal government. If you have a loan that's in default, you do have the option of consolidating the loan, which would mean that that loan would be paid off and the amount that you owe would be roped into all of that goes into the new consolidation loan. This does allow you to be out of default, but unfortunately it doesn't take the default off of your credit score and your credit report as you would have if you had done the actual rehabilitation process. So it's important that you know that going into it. But you do restore some of the privileges in terms of being able to pick your repayment plan, but even that option is minimized depending on how you do the loan consolidation. If you consolidate your loans without making any on-time payments before doing so, then you will be limited to choosing one of the income-driven plans that's offered by the federal government. If you want more options than that and you want to be able to choose any of the ones that the federal government makes available to those who aren't defaulted, then you would need to make 3 on-time, full, voluntary, consecutive payments towards your loans before going through the consolidation process, so that when that process is completed, you have your full choice of whatever student loan repayment plan you would like for your new loan. The third option for dealing with a federal student loan that's gone into default is you can pay the loan off in full. That's it. Thank you guys for tuning in. I hope this video gave you some tools and tips that are helpful for you on those student loan journeys. If you haven't, go check out some of our older videos on federal student loans and subscribe to us on YouTube and Facebook so you can see those materials as we bring them out. As always, I hope that this allowed us to help grow together financially, and I look forward to offering you more videos in the future. I'll see you next time.